Hi everyone, Martin Bamford here, and today's price inflation figures flip the script for the Bank of England, who have held out on an interest rate hike to date, but surely can't now withstand this pressure when they meet next month. In this video, I'm going to show you why interest rates are heading up in the UK. I had a pretty early start this morning. I'm not a morning person, but yesterday BBC Surrey asked me if I would come on their breakfast show to talk through the latest price inflation figures. These were due out at 7 a.m. That's not the 9:30 a.m. release that we're used to from the ONS, and that would have been fine. I was due on air at 7:07, but the ONS website crashed for me. So I think I had about 3 minutes to read the release, think about what I was going to say, and then say it. It's later in the day now, so I've had a bit more time to consider that data, and I'm confident now that these price inflation figures from today will lead to an interest rate hike next month. So let's start by looking at the data and then chat about why this pushes the Bank of England over the edge. The latest figures confirm that the cost of living is rising at its fastest pace in almost a decade. According to the Office for National Statistics, the ONS, the Consumer Prices Index measure of price inflation, CPI measure, rose by 4.2% in the 12 months to October. That's ahead of analyst expectations, and it's also a sharp increase compared with the 3.1% inflation figure reported a month earlier. Inflationary pressure is coming from surging energy prices, eating out, and the cost of second-hand cars. Grant Fitzner, chief economist at the ONS, said inflation rose steeply in October to its highest rate in nearly a decade. This was driven by increased household energy bills due to the price cap hike, a rise in the cost of second-hand cars and fuel, as well as higher prices in restaurants and hotels. Costs of goods produced by factories and the price of raw materials have also risen substantially and are now at their highest rates in at least 10 years. The price inflation basket shows components making the most significant contribution to rising prices, with gas and electricity, surprise, surprise, leading the charge. More robust global demand for wholesale oil and gas, that's making it more expensive, ultimately leading to higher prices for energy providers and therefore for us, for households. In recent months, several smaller energy companies in the UK have gone bust due to these rising wholesale prices. A couple more went under this week. They're unable to remain profitable when they're limited in what they can charge to customers because of the Ofgem energy price cap. Now, that price cap rose by £139 this month, but an energy expert I spoke to earlier today suggested it could go up by hundreds of pounds next time round at the next 6-monthly review, just to help providers remain financially viable. Another factor pushing up prices is the global supply crisis, and that's impacting on the availability of computer chips and building materials. And this significant price rise for second-hand cars is partly attributed to a shortage out there of microprocessors. So there's fewer newly built cars available. You can't buy a brand new car very easily. There's also a comparison with discounted prices during the pandemic. So things like reduced VAT costs for the hospitality sector and cheap meals under that Eat Out to Help Out scheme. Really delving into this data then, and thank you to AJ Bell for breaking it down. MDF, man-made fiberboard wooden sheets, had the biggest price rise this year, up 63%, and that's bad news for fans of do-it-yourself, of DIY. The biggest price fall in the year comes from computer games, a third cheaper than they were back in January, and that's thanks to a pandemic boom in demand. I guess we were all at home playing on the Xbox. That boom has since fallen away, and computer games have become that much cheaper since. The cost of car hire has risen by 30% this year, and airfares are up 28%, just as restrictions on international travel get removed. Eurotunnel prices are up by 21% this year, so you can't escape those higher airfares by taking a train to the continent instead. And looking at travel within the UK, coach fares are down by 24%. Rail fares only rose by 3% since the start of the year. However, keep in mind that regulated rail fares are linked to price inflation for that year to September. So if inflation sticks around for longer, well into next year, prices for rail travel could well surge in 2023. I've mentioned second-hand cars already. They've gone up in price by around 25% since January. We haven't seen price rises, though, for electric or hybrid cars. They've stayed broadly the same price throughout the year. And that, along with a desire to avoid long queues at petrol stations if we ever see another petrol crisis, that could make now a good time to make the change to EV. Doing that would also help you avoid rising petrol prices. Unleaded petrol up 18% this year. Diesel prices have risen by 17%. Commenting on the latest price inflation figures, Chancellor Rishi Sunak said many countries are experiencing higher inflation. As we recover recover from COVID, and we know people are facing pressures with the cost of living. Shadow Chancellor Rachel Reeves claimed that families will be more than £1,000 a year worse off as a result of these higher prices, saying instead of taking action, the government are looking the other way, blaming global problems while they trap us in a high-tax, low-growth cycle. What does this all mean for interest rates then? Well, the Bank of England was accused of bottling it at their most recent Monetary Policy Committee meeting when they voted to keep rates on hold. We've seen these inflation figures just a day after better than expected jobs data, and that's important here because the MPC mentioned unemployment concerns as a factor in their decision-making when they voted to keep rates on hold. We know that Bank Governor Andrew Bailey found it difficult to make the call to keep rates on hold at that last MPC meeting, and he's already expressed his concerns about rising price inflation. That fear, I think, is likely to be exacerbated by this latest inflation data. But balancing this argument for a rate hike in mid-December is the question of whether it would actually make any difference at all to rising prices. If we accept that wholesale gas and oil prices are the biggest drivers of these inflation figures, then a higher interest rate here in the UK, a hike in rates from the Bank of England, would make not a jot of difference. It would be a pointless exercise, inflicting financial pain on borrowers and potentially stifling economic recovery at the time it's much needed. But we look at core inflation, that strips out more volatile elements, things like energy, food, alcohol, tobacco. That reached 3.4% in the 12 months to October, up from 2.9% in September. And that's the figure I now believe the Bank of England will use to justify a rate hike next month. This price inflation has momentum now, and I can't see it being as transitory as many policymakers thought it would be at the outset of this price inflation rises. There's also a risk of a spiralling effect as workers demand higher wages, and that contributes to higher prices too, especially if interest rates are held so low for much longer. Keep in mind too that we are sitting on a collective £150 billion of pandemic cash savings. Certainly not all in my bank account. That's money that could be unleashed on the economy if the bank votes to keep rates on hold at 0.1% next month, and consumers just gain a bit of confidence to go and splash out over Christmas and also in the New Year's sales. What do you think will happen to interest rates next month? Do you agree with me that the bank will finally find the nerve to put them up? Let me know in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.